Have you ever flown in China? The experience is often brand new airports, sparkling clean cabins, and surprisingly punctual flights. It feels like a world-class system. China's civil aviation industry is a giant. In 2019, before the pandemic, it flew over 660 million passengers, second only to the United States. It boasts the world's largest fleet of new aircraft and is building massive airports at an astonishing rate. By all measures, this should be a goldmine. Yet, here's the paradox. The country's three largest state-owned airlines, China Eastern, and China Southern, have been swimming in red ink for years. In 2022 alone, their combined losses hit a staggering $15 billion. Even before the pandemic's travel apocalypse, their profit margins were razor-thin, often hovering just around 1%. But amidst this sea of red, one airline consistently shines bright green. Spring Airlines, a privately owned budget carrier. How is it possible that in one of the world's fastest-growing aviation markets, the biggest players are struggling while a no-frills airline thrives? Today, we're unraveling the mystery of China's aviation paradox. Let's start with the obvious culprit: costs. For any airline, the two biggest expenses are fuel and aircraft. Chinese airlines face a double whammy here. First, jet fuel. While global oil prices fluctuate, Chinese airlines pay a premium. Unlike their global counterparts, they can't effectively hedge fuel prices due to strict regulations. So when oil prices spike, their costs soar with no safety net. Then there's the currency game. Most major aviation expenses, like buying or leasing planes from Boeing and Airbus, are paid in US dollars. For years, the Chinese yuan was steadily appreciating against the dollar, which was great news. It made those expensive jets cheaper. But when the currency exchange rate reverses and the yuan weakens, those dollar-denominated debts and lease payments suddenly become much more expensive, wiping out profits overnight. This currency risk is a constant headache for the finance chiefs at China's big three airlines. But these are just the surface-level problems. The real story lies deeper, in the structural burdens baked into the Chinese aviation system. Think of it like a race where some runners are carrying hidden weights. One of the biggest weights is the collection of government fees. Chinese airlines pay a hefty contribution to the Civil Aviation Development Fund for every passenger they carry. These funds are used to build those shiny new airports and support industry development. While it's for a good cause, it has a direct tax on revenue that airlines in many other countries do not face to the same extent. Add to that high landing fees, navigation charges, and ground service costs at major hubs, and the financial pressure mounts. Then there's the sky itself. A significant portion of China's airspace, estimated to be around 70 to 80%, is controlled by the military. Civilian flights are squeezed into narrow, congested corridors. This has two major consequences. First, it limits the number of available flight paths, forcing airlines to fly less direct, longer routes, which burns more fuel and increases flight time. Second, it makes the system incredibly sensitive to delays. A little bad weather or a minor military exercise can cause a cascade of flight cancellations across the country, leading to massive costs in passenger compensation and operational disruption. It's like trying to run a superhighway's worth of traffic through a few small country roads, so costs are high and the system has built-in inefficiencies. But what about the money coming in? This is where the story gets even more complicated. The revenue side of the equation is just as challenged. The big three airlines are China Eastern, and China Southern are not just competitors, they are state-owned enterprises. This means they often operate with a dual mandate: make a profit, but also serve national strategic goals. This can lead to decisions that don't always make commercial sense, like maintaining unprofitable international routes for political reasons or being pressured to keep fares low to control inflation. This pressure fuels intense price wars. With so many airlines competing on the same popular domestic routes, the easiest way to attract passengers is to slash ticket prices. The result is a race to the bottom. Fares on key routes like Beijing to Shanghai can be astonishingly cheap, often leaving very little profit margin after covering the high operational costs. Everyone is fighting for a bigger piece of the pie, but in the process, they're shrinking the pie itself. And then there's the 800-pound gorilla in the room: China's high-speed rail network. It's the largest in the world, and it is a direct, formidable competitor to domestic aviation. For any journey under 800 kilometers, or about 500 miles, high-speed rail is often faster, cheaper, and more convenient than flying. Think about it. Train stations are usually downtown while airports are far out. There are no lengthy security checks for liquids, and the journey is smooth and predictable. For routes like Beijing to Shanghai, a 4.5-hour train ride competes directly with a 2-hour flight that requires hours of travel to and from the airport, plus security and boarding time. The train wins for many travelers. This has decimated the profitability of short-haul domestic flights, a traditional bread-and-butter market for airlines worldwide. The big three carriers are forced to either abandon these routes or fly them at a loss. Now, let's bring Spring Airlines back into the picture. How does this budget carrier manage to print money while the giants bleed cash? The answer is a relentless, laser-like focus on one thing: cost. Spring Airlines is the textbook definition of a low-cost carrier. taking the model pioneered by Southwest in the US and Ryanair in Europe and adapting it for China. Let's compare it to a flag carrier like Air China. Air China operates a diverse fleet of both Airbus and Boeing planes, of all different sizes. This complexity increases maintenance costs, training expenses, and requires a huge inventory of spare parts. Spring Airlines, on the other hand, operates a single fleet type, the Airbus A320 family. This standardization is a masterstroke. Pilots can fly any plane in the fleet. Mechanics are experts on one type of aircraft. Spare parts are interchangeable. This drastically simplifies operations and slashes costs. Next, look at how they sell tickets. Air China relies heavily on travel agents and distribution systems, which take a commission on every ticket sold. Spring Airlines sells over 90% of its tickets directly through its own website and app. No middleman, no commission. They also unbundle everything. Your ticket gets you a seat, and that's it. Want to check a bag? Pay for it. Want a meal? Pay for it. Want to pick your seat? Pay for it. This not only generates extra revenue but also keeps the base fare incredibly low, attracting price-sensitive customers. Their operations are also lean. They fly more hours per day per aircraft than the state-owned carriers, maximizing asset utilization. They often fly to secondary, less congested airports where landing fees are lower. They have a higher seating density, fitting more passengers onto each plane. Every single decision is driven by the question, how can we do this cheaper? While state-owned carriers are weighed down by legacy systems, social responsibilities, and complex fleets, Spring Airlines is nimble, efficient, and ruthlessly focused on the bottom line. It proves that profitability is possible, but it requires a fundamentally different mindset. So, what does the future hold for Chinese aviation? The road ahead is challenging. The structural issues of limited airspace and high fees aren't going away overnight. Competition from high-speed rail will only intensify as the network expands. The state-owned giants are too big to fail, but they urgently need reform. They need to become more efficient, streamline their fleets, and develop more sophisticated strategies to manage revenue and costs, rather than just engaging in destructive price wars. We might see more diversification. For instance, creating their own in-house low-cost subsidiaries to compete directly with the likes of Spring Airlines. They also need to focus on what they do best: long-haul international routes where high-speed rail is untaken competitor. The pandemic recovery offers a chance to reset, but the fundamental problems remain. The story of Chinese aviation is a fascinating case study. It shows that massive market size and rapid growth don't automatically translate to profitability. It's a tale of state control versus market efficiency, of hidden costs and formidable competition. And it's a reminder that in the cutthroat airline industry, being the biggest doesn't always mean being the best. The airline that truly understands its costs and its customers is the one that will ultimately soar. Thanks for watching. If you found this analysis interesting, be sure to hit the like button and subscribe for more deep dives into the world of business and economics. See you in the next one.